Hello, everyone. Good afternoon, good morning, maybe, or maybe have happy hour, depending on where you're calling in from today. My name is Elise Haynes from TrueSense Marketing. Welcome to the 2026 version of Giving USA. We've been doing this webinar for a long time, and we're excited you're here with us this year as we overview the highlights from the Giving USA report, overlay it with our own data and experience, and talk about, most importantly, what do these trend lines mean for nonprofits moving forward so you guys can continue to do your best work to engage your donors and to be prepared for the next gift and the next generation of giving. So thanks so much for joining us today. Today's presenters are George, Paul, and Katie, my colleagues here at TrueSense. I'm very excited that you're going to get to hear from them. We put a lot of work into this presentation. I've learned a lot. I'm sure you will too. And without further ado, Katie, take us off.
Awesome. I will kick us off. Good afternoon, good morning, good day to everybody that is here. We're going to start off with a couple snapshots and main takeaways from the Giving USA 2026 report. We are not going to go into every slide and every detail that they shared as part of this report, but some views that we think are the biggest takeaways for our discussions today. Just as a reminder, what is Giving USA? It's the longest running annual report on U.S. charitable giving. Many of you on this call are familiar with it and the data that they publish. It includes estimates for sources of giving and amounts received by type of organization. It is, of course, published by Giving USA Foundation, and a little background here below for anybody that is interested. And the couple snapshots we want to share today, starting with total giving, spanning from 1985 to 2025. 2025 reached $617.2 billion in terms of total giving. That represents a 5.7% increase from 2024, which also represents a 3% increase when adjusted for inflation. We wanted to note that 617 is the highest that total giving has reached since we exited the COVID pandemic. So interesting data point there. And then you can see here as part of this chart that total giving has either increased or stayed flat for almost every year within this time frame, outside of a couple. 1987. Seems like forever ago, 2008 and 2009 for obvious reasons, and then 2022 as part of the pandemic and exiting the pandemic giving. Additionally, we wanted to note that as of 2025, foundations and corporations reached an all-time high in terms of total giving. And then bequests also reached the second highest all-time giving as part of the 2025 benchmarking. So let's dig into that a little bit more. Again, this is Giving USA's slide on the total giving by source in 5-year spans from that same time frame. We wanted to note that individual giving in the last 5 years has only nominally increased in terms of the larger marketplace. But as I mentioned on the slide before, giving by foundations and bequests have continued to be on the rise, again, as part of this time frame. And foundations and bequests, that total giving has not declined once during this same time frame. So something for us to be thinking about as we start to overlay this data from a TrueSense perspective and from a direct response perspective. And then this is charitable giving graphed against the S&P 500. Obviously, what we're looking at here is the correlation between philanthropic giving and the financial markets. So what we wanted to point out as part of this chart is that in the last 5 years, looking between 2020 and 2025, there was a weaker correlation between the amount of giving as compared to those financial markets. So we're going to talk a little bit about just general lower participation, again, looking at some of our data and what that means for the industry. We hear a lot about how the market is faring, uncertainty, inflation. We're going to talk a lot about that as well, but want us to keep this in mind as we dig in a little bit more. And then lastly, we always like to look at individual giving when we're talking from the lens of direct response. Individual giving is the bread and butter of most of our direct response programs. And so this chart from Giving USA talks about individual giving as a share of disposable personal income, again, over that span of many years. And in 2025, you can see that a dipping a little bit. So again, it's important for us to think about that. How are individuals giving? How is this going to translate into what those individuals are giving philanthropically to all kinds of direct response programs? And we're going to unpack that a little bit more. So I'm going to start us off maybe on what we might consider a heavier note, but a little bit about the key challenges, right? And I promise we're going to bring it back around at the end and turn some of these challenges into opportunities and how we're managing them for our clients and our fundraising programs. But let's talk about just direct response for a second. For most of you on this call, these challenges are not going to feel new. They're not coming out of left field for most of us, and they're challenges that we've been talking about quite a bit, especially within the last 4 or 5 years as we exited pandemic giving. So rising costs, it feels like we are talking about this every minute of every day, but just as a reminder, when it comes to direct response, costs are on the rise. Acquiring new donors is more expensive than ever, especially when it comes to direct mail programs. But from a multi-channel perspective, it is costing more to bring on new donors. We talked about this a lot during the pandemic, but higher production costs, higher paper costs, and we know that postage costs when it comes to the mail are continuing to rise. Inflation, economic uncertainty, and general tighter budgets for the donors that we're looking to get a gift from. So it's something we have to keep in mind as a key challenge. We've also been talking a lot over the last couple years about the value versus volume model, right? Which can mean different things for different channels and different programs and different clients at different times. However, in the last 4 or 5 years, and predating that a little bit as well, success for our direct response programs is no longer driven by just volume alone. We can't just get all the donors all the time, always, and have successful programs. First of all, it's not realistic. It doesn't take the value of those donors in mind. So just numbers, the most donors possible is just not the way we think about direct response anymore, especially keeping in mind those rising costs. So it's forcing us as an agency and as an industry to think about our multi-channel decisions and make sure that they are focused as much as possible on the strongest return on investment, regardless of channel. Thinking about laddering back to those higher costs. What is our cost to acquire for certain donors, certain donor bases, and certain channels? And then especially in direct mail, thinking about that break-even point. Is it healthy? Is it sustainable? Does it make sense for this program and this organization, right? So we always have this challenge in mind. And then if you have been looking at any kind of benchmarking in the last, again, 4 or 5 years, we are being beaten over the head with response rate challenges and retention challenges, right? So it's an extremely crowded marketplace in philanthropy. Donors are receiving more outreach than ever, especially as programs become more multi-channel and we have more levers that we can pull to make that possible. And as a result, we have seen declines in response rates across channels. Of course, there are exceptions, certain missions, certain times of year, right? Certain key campaigns, but in general, response rates are softening, and we need to keep that in mind. And additionally, there are ongoing challenges, not just from a cost perspective, but a response perspective in acquiring first-time donors and then keeping those donors on file and engaged, a la struggles with retention. So we're going to bring this back around to talk about how we're approaching it, but I'm going to kick it over to Paul to dig into some of our TSM perspective and data.
Thanks, Katie. So today we're actually going to build on what the Giving USA report has, looking at 2 different additional perspectives. I'm going to be talking about our surveys with donors through the True Brand initiative that we have. And then George will be looking at actual giving information to see where we see additional insight that we can build on from the Giving USA report. So for background, TrueSense runs a continuous brand tracking survey. This current set of analysis that I've included in this report covers 7,000 different surveys of people who self-report charitable giving. The brand tracking that we do is very focused on the process from awareness all the way down the funnel to both conversion and preference. The one thing to keep in mind as we compare these two different sources for some additional insight is that in a survey environment, this is self-reported. It's very different than the analysis of specific transaction data that Giving USA builds on and that George is going to be speaking about. But what it can do is give us some additional insight into the way that the donor perceives themselves in this current environment. So I wanted to pull some insight related to the tension that Giving USA speaks to, is that while there was a 5.7% increase in total giving, the actual participation by individuals has declined over time. And we see that even in the donor survey reports that we have been fielding across the last 2 years, where the number of households that are participating has either declined or been nominally the same year over year. So we're seeing multiple sources of information that point to a lack of growth in participation in charitable giving by individual households. You compare that to year over year growth rates, what we're essentially seeing is a concentration of giving by a smaller number of households as a decade plus trend in philanthropy. We see this again when we look at the critical group of households that are giving to more than one organization. They are representing an outsized group in terms of their value across direct response in particular. And so we've actually seen a more notable decline from this audience in giving in the current environment. It could be inflationary pressures, it could be a lack of growth in disposable income, but we did see a decline from around 25% to 23% in the 2026 data so far. And this is a parallel to a point that Giving USA calls out from the Philanthropy panel study, where they've seen a decline from 80% of households giving in the 1980s to only 65% in the most recent time frame. It's a pretty significant change demographically in how households are engaging in philanthropy. The other thing that they point out in the Giving USA report is the continued growth in the number of registered charities in the United States. We're now at a total 1.5 million registered charitable organizations in the United States. And at the same time, with the number of households giving declining, we're seeing a lot of competition for awareness and a lot of competition for the ultimate charitable giving decision. On top of that is the continued increase in exposure to all range of communication across social media. It's the awareness, ability to engage someone's awareness has become very difficult and a challenge. And we can just see that already in our data right now. Across 5 of these household brands that we track, and we track a total of 9, we've seen awareness decline year over year for these organizations. Getting attention in our environment right now is pretty difficult. Now, one of the things that Giving USA can't necessarily do is dig down into looking at some of the demographics that we're able to pull in our survey. I think from a position of optimism, one of the things we consistently see in our survey is that we underestimate the participation of younger cohorts in charitable giving. And while they may not have the same gift size or consistency as older cohorts, we're definitely seeing continued interest and value in charitable giving at younger cohorts. And in some cases, we actually see younger cohorts with a higher interest in charitable giving participation than the middle cohort there between 40 and 59. The other thing that the Giving USA's approach really can't cover is some of the deeper motivations and value issues that we're facing. They're looking at it from an economic perspective, which has very real consequences. Inflationary pressures, lack of growth in income, these are all variables that are impacting a decision to give. What it can't necessarily do is address some of the psychological background. And so in our True Brand survey, we can start asking people around motivations for giving and how they perceive different brands. Right now, the strongest indicators for when someone is likely to convert and make a donation, there's two variables. One is that they trust the nonprofit organization and that the nonprofit organization shares their values. You can see here across almost every single of these different nonprofit organizations we're tracking that when someone donates, it comes with a much higher trust in the nonprofit organization. So understanding not just the economic impacts, which the Giving USA report really calls out and highlights, but it's also important to think about other variables that are impacting that decline in participation from 80 to 65% over the last 40 years. It also correlates with the general decline in trust that's been happening for the last 50 years. There's some very long surveys that demonstrate the decline in trust in our society, and it could be one of the more significant variables in that long decline in charitable giving, because throughout that period, there's been a variety of economic conditions, but the actual decline in participation has followed through that entire period of time. And then lastly, a note of optimism here. We have actually seen in this year a rise in the trust metrics across the different organizations that we're tracking. They are ahead of the donation behavior. So essentially, we're seeing more fertile ground for giving in the current time frame. And what we haven't seen yet is that transition to conversion behavior. That could speak to a greater weight right now to economic and political variables when people are deciding to give, or it just could be a timing issue. And as we approach the fourth quarter of this year, we might see an improvement in charitable giving that follows the improvement in trust that we're seeing right now. And I'm going to pass to George to dig into some of our data to keep building on the relationship with some of what we're seeing in Giving USA.
Thanks, Paul. Yes, Paul just showed us some very exciting data based on self-reported data, right? So we now let's take a look at some real donation statistics. And in this example, we are using a GPS Plus system to analyze large organizations' entire donor file. Just for background, GPS Plus is TrueSense Marketing's next generation modeling system that helps us identify and quantify new investment opportunities. Like in this case, the GPS Plus system identified 6 distinct audience groups. And if we focus on the top 3 audience groups, they represent only 20% of the total donor universe. But instead, they generate 98% of the all revenue to the organization. And in particular, the very best 0.6%, which is labeled as major donor leads, they produced about 72% of total revenue. So revenue concentration pattern is real, and we have seen this pattern, a similar pattern across our clients. So it resonates with the Giving USA report at the micro level.
And George, we have a poll. As we think about that top 20% of the audience, we're very curious to get feedback from everyone about how you feel your marketing outreach is connecting with that top 20%. So if you'd be so kind as to go over on the bottom right, click polls, submit this information. It would give us some great perspective on how you feel you are connecting with this group of people who are contributing anywhere from 80 to 90, in this case, in this example, 98% of the revenue. So if you could do the poll, that would be great.
All right, so understanding 72% is today's ratio, right? This sounds a little bit extremely high, right? So what about the history? Now we use the same GPS plus system to look at the same donor file over the last 3 decades. And the finding was very revealing, right? So in history, in the past, that revenue concentration wasn't that high. Instead, it was actually quite low back in the 1980s and the 1990s. That ratio of revenue from the top producing elite group was only 13%. Then after that, that ratio kept climbing quickly until it reached 72% last year. So what does that mean? So intuitively, we can think whatever worked many years ago, whatever the vision was, the strategy we put in place many years ago may no longer be as applicable today. And on the other hand, as the share of revenue from the top producing group keeps climbing, intuitively we can think the share of budget for the base programs, not just direct response, but all the base programs will continue declining. So on the surface, it's going to show as a conflict or competition between different medias, So, but in reality, it's not a media competition. Instead, it's more about wealth competition. It's a vertical competition rather than a horizontal one. Now, when we combine, this is a view, it's sort of like a repeated from the previous chart, but we put all the other audience groups stacked up against the top audience group. The pattern here is a clear K-shaped growth. For those of us who are not very familiar with the term K-shape, it just means a widening divergence between 2 groups. Or perhaps in more basic terms, we can understand this as the world has become more and more divided, right? So today's fundraising success depends on a smaller number of outstanding donors, just more than ever before. This is a reality we need to accept. It's not something we need to fight, but it's a new trend we want to ride instead of challenge or try to fix. Now, let's switch the topic a little bit, but this is closely related to the wealth concentration we just talked about. Let's focus on inflation now. So there are multiple impacts that can become real, right, from inflation. Just first of all, for background, in the United States, the cost of living has risen by 26% since 2020, as compared to less than 1% year over year in the preceding 20 years. That's based on official statistics. So on the cost side, it's easily understandable that everything has become more expensive because all of us are feeling that pain every day. But on the donor performance side, the impact becomes a little bit more profound because it depends. The impact of inflation on the donor performance side, it depends on the exposure to the inflation risk. This chart profiles, audience direct mail audience versus digital audience versus the US population as an average, as a benchmark. So as we can see here, direct mail audience looks quite similar to the US population, right, by wealth profile, which is good news. It means direct mail usually has broader reach to every segment of the population. But on the other hand, the direct mail tends to is more susceptible to inflation risk, because it's understandable that the least wealthy donors tend to pay more out of pocket these days to pay for necessities, so that they don't have as much left over to care about other needs in their daily life. But on the other hand, we need to understand that the wealthy population tends to benefit from inflation. How do we understand this? Let's think about this. Inflation, by definition, means excess money supply. In other words, there is more money available in the market than necessary. So when there is additional money available, where does it go? You can go to stock market or go to gas station. But a large chunk of the excess money supply actually is being absorbed into financial market, right? And within the financial market, it has the magic. The financial market has its own magic to multiply that additional money supply, so that the inflation within the financial market outpaces the inflation in the store, in the supermarket, in the store. So that is why, and the inflation in the financial market is also known as asset appreciation. So whoever has more financial asset tends to benefit more. That is why the wealthy population tends to benefit from the inflation in the last few years. Now we have covered the impact on the cost side, from the donor preferred fund side, but there's another subtle factor that people often ignore, but it can be even more significant, which is in the loss of real dollar value. In this chart, we show the long-term net value, cumulative long-term net value of a direct response acquisition program. The top curve assumes there is zero inflation, right? Which, excellent. It shows a very good, very strong number at the end of 5 years. It's about $84 at the end of 5 years from acquisition source, from the point of acquisition. But the middle curve is based on assumption of 5% inflation on an annual basis, which I think is roughly true to today's reality, because the US, think about this, the US money supply as measured by M2 has been increasing roughly about 5% annually. And the bottom curve is based on extreme assumption, extreme case, right, which is about 10% inflation rate. So from no inflation to 5% inflation, the cumulative net present value, by the way, net present value is calculated based on discounted cash flow by the corresponding inflation rate. So we want to discount the future cash flow back to today's dollar value, so that all the investment opportunities can be compared on an equal footing. So between no inflation and 5% inflation rate, the NPV is going to drop by half. And if there's, and with 10% inflation rate, basically the net NPV will vanish, will disappear, right? So with an 87% loss. So what does this mean? So it's usually, the implication here is also very significant, because with high inflation rates, people will have to think more about short-term decisions, right? as opposed to long-term investment considerations, because the long-term has so many uncertainties because of this high inflation rate. And even if when we have to consider long-term, that the future return, the future cash flow must be significantly enough to justify our investment today. So in reality, we often hear, organizations say, we want to cut acquisition and put the cost savings in somewhere else, into, donor advice fund, for example, right? So high-end donor upgrade. These are good examples of, favoring short-term, immediate, significant cash flow over long-term investments. So again, as Paul and Katie just mentioned, a traditional volume-driven business model is not going strong at this moment because of the revenue concentration. And on top of the revenue concentration, we have this inflation going on since the beginning of COVID. So next, Katie is going to show us a summary and some important key takeaways for us to consider.
Awesome. Thank you, George. I would just like to put my positivity hat on for a second and, remind us all that, first of all, I'll say, coming out of the pandemic, the last 4 or 5 years, 6 almost, have probably felt like the wild, wild west when it comes to professional, personal. There's just been a lot. However, challenges in the fundraising industry, in philanthropy, in direct response are not new. We always have some. We are always, rising to the challenge, strategizing. So, we don't want to end our discussion today on inflation is horrible and let's all pack up and go home, although it's very, very important for us to have this information, in our lens as we're planning and looking at how we want to innovate and take our programs to the next level, right? So let's talk about the challenges, what we just highlighted, and where we can turn some of this into opportunities for our programs. And many of you and us at TSM are of course already and in real time adjusting to these challenges. But when we talk about those rising costs, which again can kind of feel insurmountable for certain challenges and certain programs sometimes, and George alluded to this, there were a lot of organizations that had to make tough investment decisions during COVID, and we are still kind of on the tail end of that, either trying to rebound, but often we're not able to lean heavily in, pull back out, jump right back into where we were in terms of investment into direct mail or whatever it may be. So like George said, we're really trying to focus, especially in direct mail, on mailing smarter, not necessarily harder or more, right? What are the appropriate volumes for our budgets and for the programs that we're managing? And we do that by pursuing the right or the most strategic and best audiences we can. That also comes with, and George alluded to this as well, the strategic investments by channel. We need to be able to be flexible and ebb and flow with, both the industry and the performance of organizations we're working with or working for. So what are the right investments by channel? And especially coming out of COVID, how do we avoid or plan best as possible so we don't have to make knee-jerk reactions to pulling out completely of certain markets or audiences, and just trying to keep the most well-rounded approach possible, especially when it comes to investments. We know it takes really a long time to bounce back from kind of that shock to the system. And a lot of what we're doing is, and I think as an industry, we're focusing on combating these costs by growing different types of giving and different types of revenue streams within, direct response programs and, for organizations. So I don't really know any organization these days that isn't focusing on growth of sustainer programs. Again, the investment level needs to be the right thing for the organization and where the program's sitting currently, but diversify and feel like we have a solid base of sustainer and monthly giving. We've been talking about foundations and bequests and corporations. How do we promote that type of giving? Direct response is not going to be the primary channel, or mail or digital or whatever for certain functions of revenue streams, but how can we promote DAF giving? That's, a huge topic of conversation in our industry right now. And then when George is talking about, and Paul, this small portion of high value audiences, we need to make sure we're maximizing them best as possible. Again, investing in those groups when it comes to a cost perspective to get the biggest bang for our buck. And then again, that value versus volume model. I'll say it again, during the pandemic, there was a lot of push, and primarily pull of, how can we either balance focusing on value or volume. It does need to be a strategic, balanced approach that is right for your organization, but that value is becoming extremely important over just as many donors as possible, regardless of amount, regardless of value, and retention. We have to be more strategic, because board of directors, organizations are asking us as an agency to create and help feed sustainable programs for them, both from a revenue and a net perspective. And George talked about our modeling capabilities at TSM. Many of us are using these, implementing these, and that's going to continue to grow and evolve, but we need to be leaning in on that value, finding the right value, using all the modeling capabilities we have at our disposal. And that is focused both on acquiring the right donor at the right value, and then resoliciting them as efficiently as possible. And that can come from change in Marcom, change in how many efforts and touch points donors are getting, thinking about that crowded marketplace, which donor group should be receiving 12 appeals versus 24. There's all kinds of ways we can strategize around that using our modeling capabilities. And then last but not least, those response rate and retention challenges. Both George and Paul said this. There are, for some organizations, while total revenue may be staying flat or even up in some instances, that is coming from a smaller donor set, fewer donors giving more. That trend could change a little bit too here in the next couple of years, but that is speaking to focus on value, not volume. And we have to be mindful when we think about outreach, number of touch points, the type of communication, the messaging, that we have fewer donors on our file than we did 4, 5, 6, 10 years ago, right? And that changes how we do things. When we talked about value versus volume, we use the term efficiently, right? At the donor level, not necessarily just a marketing communications calendar, but when we're thinking about response rates and retention, we want to focus on effectiveness of our outreach. Paul talked about this a little bit, but we have a great opportunity in direct response. We are going to our donors in the most direct ways possible, right? As we're fighting for attention in this crowded marketplace, we want to be thinking about intentional donor experiences. What does that mean to the organizations we're working with or for? We have an opportunity when we're directly connecting with donors to focus on personalization, not just personalization everywhere all the time always, but the right personalization to the right audience. How do we make packages and paid advertising and emails feel relevant when we're fighting for every donor that's out there in the marketplace right now? And we want the experience that donors are having with these organizations and the missions to feel very rewarding. And again, we have a great opportunity within the types of fundraising that we do to make that really impactful. So that is leaving us on the most positive note that I have today. I think we're transitioning into some questions. I see Elise popping back up. I'm going to forward to the next one, and that's it for me.
Great. Thank you, Katie, Paul, George. Thank you all. I'm going to minimize this slide and make our faces bigger. That's the information about the upcoming Quick Bite webinars. The links for those are in the links list. But let's get into some panel discussion. So the first one for you guys is, that number of 617 billion figure raised last year. If someone just had that top line number, what would you tell someone that number is hiding? If you could do that in just like a sentence or two.
Yeah, I would say just the revenue concentration hides the overall giving number. It's it's as we just discussed, it reflects a divided world, right? It's a K curve. The K curve behind this number is perhaps more important for us to understand, and that K curve is a long-term trend rather than just something new after COVID.
Feels like every year is something new a little bit.
Yeah, and it's just a reminder to, big numbers are exciting, very sexy, but unpacking them when it comes to, the actual type of fundraising that we're doing.
Yeah. Yeah, to me, it has a lot to do with the source, like looking at where that revenue is coming from and what's activating it. That growth is coming from a very small group of people who have access to growing capital as a result of the market and inflation. Earlier, we had talked about how if you think about people who rent and the people who own the places that people rent from, they're benefiting from those rent increases. They now have more disposable income and more capital to reinvest. But the people who are paying rent and whose income hasn't been going up, their disposable income is going down. So there's the divergence we're seeing in our economy is now reflected in philanthropy. So in general, the economy is generally seen as healthy right now, especially with the market, despite all the instability. But for the average American, things are more difficult. The only thing that's kind of odd, though, we didn't really speak to it, is that even though the market has risen significantly recently, the subsequent rise in revenue hasn't followed it. So I also wonder, too, for people with resources, people invested in the market, it's positive, but there's still a significant insecurity that is actually keeping charitable giving from rising even more than it has in the last year.
All right. One of the topics we've talked a lot about in this webinar in past years is the democratization of giving. And as the analytics show, that donors who give more are better for your file, cutting off some of those lower value donors. Are we comfortable with where that ends as this like quietly deprioritizes those mid to low donors? What's the thought on that? That's like a philosophical question, but one that comes up a lot here.
Yeah, I think it's more the exact cutoff line is dependent on the financial ratios. Whatever is justifiable in financials will have to be taken into consideration. It's not something we want to, let's include more donors. We want to keep including a large number of donors. That if that doesn't really pass the financial test, it won't work, because especially against today the big background that a smaller number of donors tend to account for a larger share of revenue. Because from an organizational perspective, they will have the fundraising business is business about money, right? So you have to consider these financial outcomes and way before it happens down the road.
And I think it's also, speaks to the importance of getting under the hood of the analytics and well beyond just upfront campaign performance by channel, and utilizing our also modeling capabilities to, it's not just a sweeping all $25 donors are gone, but to George's point, what makes sense from a financial perspective, using all the attributes that go into the modeling to help us decide which times of year and which outreach, right? I think it's scary to think of any broad sweep. And, there's a great place in some programs for $25, $50 donors. It just has to make sense from that investment, that costs, and that long-term ROI perspective.
I also think we need to think holistically too. There's been a lot of studies that have shown upper funnel type marketing is both effective for prospects and donors. donors, right? So if we deprioritize certain donors in like mail, for example, because there's a lot of inflationary pressure on that, because they're either infrequent in their giving or they're very small gift donors. That doesn't mean there aren't opportunities to engage those audiences and create opportunities for them to give. It's just we're looking at the right channel mix to make sure that we're not overspending against an audience who, if I sat down with one of those donors who's given once and has no plan to give again, and I said, hey, should I keep mailing you, 18 times a year? The person would be like, no, like I'm not going to give again, right? So there's it's like looking at it from the donor experience perspective can also help make some decisions around spending and how we prioritize audiences.
And I think what you said, Paul, is funny. It reminds me of, sometimes we go to do mid-level or major donor versioning. It's like, oh, well, we want to update messaging to say like, oh, they're extra important. They're extra special. They're extra leadership. $25 donors can feel the same way about, their contribution. So it really just also stems from the analytics, create how we're treating them. Any donor that's, not any, but many donors that are raising their hands to support, can have a place in the hierarchy.
Yeah. Yes, and considering the world has changed so much in the last few decades, that the wealthy has become more wealthy, right? So I think it's right for the wealth group to take more responsibility, right, than before. So, and I think I would probably ask the question in a different way, in a slightly different direction. So are we sure these wealthy donors are already doing enough of their jobs, rather than, looking at the statistics? Yeah, there's a large share of revenue coming from them, but is this enough for them, right? So we don't know, but we can find out.
Earlier this year, the independent sector's report on trust in the U.S., trust in institutions, showed that trust in nonprofits was on the rise. I think it was up to like 57% of respondents, much higher than people's trust in other institutions like the government or etc. And so what are strategies that nonprofits can do to continue to build trust with donors? 57% is much better than the other organizations, but there's still a lot of growth to do there, right? And so what would you guys advise on that aspect?
I think default is to creating that feedback loop, right? It's the responsible use of a donation. So when someone gives, it's reflecting the fact that you received the donation with a timely acknowledgement, but then making sure that Marcom has very clear reporting back on the value of their giving and the impact the organization is having. And actually, I think that's a clue to when we talk about redirecting money to, let's say, an audience with larger giving. The question is, how do we engage that audience to improve retention there, but also the value? And that might mean more communication that doesn't come with the direct, immediate reward of a gift in response, but where we're actually putting more energy into communicating the impact of giving. And so those additional touch points could actually help improve the trust that different donors have. And we have the latitude to do that because of the size of their giving.
And this is a very boring answer to this, but I would also say don't keep an eye on your data hygiene, right? Some of those suppressions that are just burned in the back of our minds from our day one in the industry. Mail me twice a year, don't mail me at year end, do not call. We talk a lot about this with texting programs and a lot of different, different channels, but those things are extremely important. And, one or two donor calls that they get to an organization, you told me you weren't going to reach out to me, I asked for this multiple times and it still hasn't happened. Those make a difference to the people that are answering the phone and managing, and also make a difference to donors. So just keep that hygiene updated and manage it best we can when we're doing outreach.
Yeah, I would add that the decline is a so-called decline in trust maybe is a result of dilution, right? So because as there are more and more nonprofit organizations added to the mix, and compared to commercial industries, nonprofits don't usually go out of business or go bankrupt as frequently as commercial companies. So we have to live with more and more nonprofits today. So there is a natural dilution of attention, trust. So I would say maybe we shouldn't overreact to whatever the survey says, but it is just a new reality we have to live with, to keep in mind.
And I think also that lends itself to what makes your organization different. When there are multiple doing similar missions with similar names, it's ingrained for us because we're keeping track of, every acronym and, all of this. But from a donor perspective, two like-minded organizations that are working on a similar healthcare initiative might feel one and the same. So we often grab from competitors, but how can we really stand out, be a disruptor, whatever that looks like. So that's more creative messaging standpoint, but what makes any organization different to break through the noise.
Mm-hmm. All right. Well, thank you guys so much. Any final thoughts before we wrap it up?
Mm-hmm.
No, thank you guys so much for coming.
All right. Yes. Thank you for being here. And hopefully we'll see you at one of our webinars in the coming weeks. Enjoy the rest of your morning, afternoon, happy hour. Thanks, guys.
Bye, everybody.